by just growing that network and thinking about building your brand, I mean, you're just setting yourself up so much more success, no matter what you end up doing. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Feras Moussa. Feras, how are you doing today?
I'm doing good. How about yourself, Todd? Thanks for having me.
Yeah, man. I appreciate you being on. I'm doing excellent. A little bit about Feras. He's a managing partner with Disrupt Equity, which is a firm that identifies, owns, and operates multifamily properties, mostly out of Houston. Is that correct?
Yeah, throughout Texas and Florida and Georgia. So we're kind of
Okay.
making another bigger push into Florida.
Got it. So Disrupt Equity focuses on multifamily and syndicates the equity through their investor pool, helping their investors achieve strong returns from investing in real estate. So anyways, with that said, Feras, why don't you give our listeners a bit more about your background, and then we can dive in a bit more to just kind of what you guys are doing.
Absolutely. So, like a lot of your listeners, I kind of come from an engineering background, specifically kind of came from the tech world. So graduated computer science, worked at Microsoft, and, after leaving Microsoft, had a software company for a while. And like a lot of people was looking at investment opportunities and, wasn't too interested in the market at the time, had done enough of that. And, I ended up getting into real estate. And so my first purchase was a fourplex that coincidentally is about a mile and a half down the road from our corporate office here in Houston.
Do you still own that?
I know I sold that about 2
Okay.
years ago.
Okay.
And then, so, that was my first purchase ever before I bought a house or anything.
Hmm.
Then ended up doing 4 more transactions in the following 6 months and realized it just doesn't scale very well. So, kind of from there ended up shifting into apartments, started Disrupt Equity, and the rest is history. So today, we're obviously based here in Houston. We've bought, 650 million-ish of assets. We are vertically integrated, have our own management company as well to those first and third party management. So it's definitely been a wild ride and never would have expected it kind of get to where it is. And, I think we're just getting started as a company. So.
Yeah, I love that for just getting started.
Yeah.
So I wonder why that is. Like, why do people? Everybody says the same thing. I hear it over and over. Like, oh, I bought some duplexes. I was going to keep on doing that, but just found out it just doesn't scale very well. Why do we start at the duplex or the single family house? Like,
Easy.
it's just because it's so easy, or
Well, I think people start, it's easy, get comfortable with the numbers. And I mean, there's value in starting there too, right?
yeah,
Like I learned a
yeah.
lot flipping, doing some of these things. Like I got a good sense of what things cost and what some of that effort looks like.
Yeah,
So
you got to get started, right? There's something to be
yeah.
said about just getting started and getting going, doing things, taking action, right? You
Yeah.
just
And for
have to.
people, if you don't have the money, you can imagine borrowing, raising $50,000. Most
Yeah,
people can't imagine borrowing, raising $5 million, right?
yeah,
So,
true.
then that's probably the other thing. It's an achievable step to most people's mind. And, and there's not a right or wrong, right? I want to reiterate that. I tell people that you can make money in real estate a million different ways.
Yeah,
There's not a right or wrong way to do it, right?
yeah,
There's guys that I know one guy that owns 120 houses in Vegas, right? He's done very well for himself.
yeah. So I mean, it's just like you got to get started somehow, right? It's. I feel like there's got to be some point though. It feels like most people, and I've some people like this. Your buddy in Vegas maybe has success at scaling, but it feels like there's this level where did you hit that point where you're like, okay, I just can't keep going.
Yeah, so I think the most common levels people run out of money, right?
Is
And
that
then
what
you
happened
either
to you?
and so for me, did I run out of money? No, not quite, but I would have at the next deal after that, right?
Sure.
Like for
You're
me,
getting
it was,
there.
I knew I wanted to do an apartment. I knew it had better numbers. And
Yeah.
so there was a 99 unit that I knew I could, no, actually I'll take it back. I would have ran that money at that one. It was a $5 million purchase, $1,000,001 of equity. And I didn't have $1,000,001. I knew between me, friends, and other people, I could raise the 1,000,001.
Yeah.
So that gave me the confidence to do that deal. And so, yeah, actually on that deal, I would have ran out of money. Um, for me, it was more about I just didn't really enjoy just kind of the how much kind of labor intensive it was,
Yeah.
right?
That was
And you kind of have
mine.
to cross that chasm, right, between
Right.
how much labor is it versus what do you get out of it versus, hey, you know what, let's go do something bigger, full-time staff, and now it becomes more managing people than it is managing, everything that has to happen.
Yeah. Now that was kind of mine. It's like, man, I'm not going to be just keep on and be able to do these, couple duplexes, single families, and like it's just going to take forever to scale. And sure, could I do all right if I keep going? But for every deal, the margin just seemed like it got tighter. So I'm like, man, it doesn't seem like it's worth continuing. How did you then scale going from the duplex? What was your first apartment deal? Was
So it
it
was actually
big?
a fourplex was the first one I bought. Then I bought a bunch of houses.
Okay.
Then, kind of jumped ship to that 99 unit,
So the
right?
99 unit was your, and did you do a syndication or what'd you do with
I
that?
syndicated it, yeah.
Yeah. Yeah.
And so, if
Awesome.
you kind of start to learn, and then the more you get educated, right, the more I'm like, all right, this makes more sense to me, right?
Yeah.
Forced depreciation is a thing in commercial. I can't do that in houses, right?
Yeah. Right.
I literally know a guy that bought something like 40 houses in the same neighborhood and sold himself, one of the houses at a high price point just to try to show, look, the comps support this new price point.
To
Right,
force
but
some
that's about the only
appreciation.
way you can do forced appreciation in single family, right?
Yeah.
So versus commercial, it's part of the business, right? The valuations are based on income, and so it made a
Yeah.
lot more sense to me. And I'm just a more of a math numbers inclined guy, and so you start learning more and more and more, and I'm like, all right, this makes a lot more sense to me.
Got it. And so take me to where, you go from that 99 unit, then what are you guys focusing on today? What's your, I guess, really, what's your kind of ideal property?
Yeah, so today, we have a deal closing in 2 days, and that's kind of the ideal property today, which is, late 90s construction, 2 to 300 units, 2 to 400 units, anywhere that space is kind of a comfort deal. And deals where we can step in, do a value add component, but it's not a distressed situation. That
Mm.
99 unit was a distressed situation. I mean, that was a rough deal, rough area. We completely turned it around. Whereas, an ideal property today is more, step in, inject some fresh capital, and innovate, improve the property, right? And then from that, we can kind of achieve the return profiles that we're looking for.
What's why the change then? Why? Because you said you started at 99, it was a rough area, a lot of renovation, big turn. And now you've got 1990s. Sounds like pretty easy
It's
to,
for us,
what
it's
was the
where the
difference?
market is, right? I mean,
Mm,
ultimately we can go do those value adds too, but the problem is you're doing a lot of work and you're not really getting much for it, right? Too much of the value adds already been priced into most of these deals versus some of the, we like to do the bigger, newer stuff where yes, there's a little bit of institutional competition there, but it's not as kind of of a frenzy as some of the value add stuff, right? Because some of this value add stuff, I mean, the perfect example is stuff in Atlanta where the broker will try to pitch you on buying it for 200 a door. You put another 30 a door into it, 30, 40 literally into the deal. Whereas
yeah.
most of our upgrades are 10 a door, right? So you put another 30, 40 into it, your cost basis is 230. The argument is, well, you're achieving the same rents as the 20-year newer property down the road that you could buy for 260. But I'm like, well, I'd rather pay 20, 30 more and get that new deal versus,
Yeah. And
you
cash
know,
flow right away, right? We're getting the cash flow
yeah,
right
so not having
away.
to do
Or,
this kind of insane value add. And so, whenever we bought that 99 unit, I mean, it was priced right. Like I said, it was a $4.1 million purchase, and we bought
mm,
that thing, 40 a door, 30, I think 36 a door. You can't
yeah.
find that anymore. That same deal today is going for 120. So, as a result of that, we shifted to just kind of stuff where you can keep your hair a little bit more. So
Yeah, it makes sense. Are you focused on specific, you know, area, specific demographic? Is there certain things you're looking for there?
yeah, I mean, right now we do look for better deals, better locations, right? It's, we've done the rough deals, rough locations, and there's nothing wrong with those. But it's ultimately right now it's lower risk, right? And it's just easier to operate. And so kind of you get the best of both worlds. And it becomes more about deal structuring, right? How do you structure a deal with a capital stack that, reduces risk for your investors and at the same time can, create an incentive for the investors that's attractive. And so it becomes more about that and less about, hey, can I reposition the C property to C area, make it a B and a B, right? You
Yeah.
can't control the area, but you can definitely control the asset quality.
Yeah, definitely, definitely. You could, I love that. I mean, you for sure can't. You can do some things to improve the property. Certainly, you can make the outside look better, and maybe your property is the worst and it's creating the crime in the area. But typically, if the crime is in the area, you just can't take the crime out, right?
No, absolutely.
If it's solely on your property, okay, maybe, but that's usually not the
You
case.
you have to buy up half that area, just like that neighborhood I talked about. So
Yeah, yeah. Um, explain. A lot of people love being vertically integrated. You guys are vertically integrated, but you're in multiple markets. What are some of the pain points? What are some of the difficulties about being in multiple markets yet managing those, or are you third party managing out of state?
so we manage in multiple markets in Texas. We do first and third party for, we manage other people's properties within Texas.
Okay,
Outside of Texas, we use third party management for
got
now.
it. Yeah,
And so, but it's kind of a mixed bag. And, ultimately with management, it's all about the people, right? It's the worst business in the world, but it's a necessary evil, right? In some ways. And it's really about getting people that you trust. Because, really, if you think about it, management is not about managing people super closely. You have these sites essentially, right? These remote sites that are all over the place, and you have to trust them to do the right thing and be, be confident, be trustworthy, right, and do the right things. Versus you can't, you can't be there every day, right? You're not. The goal is not to micromanage them. It's really about putting in an effective leader and trust them to do the right thing, right? And
yeah,
then kind of monitor from there. And so that's what makes it hard at the same time because you get the wrong person in there and it can very quickly go downhill. And so, like I said, it's a tough business, and it I think it's got just a negative stigma to it. And most people in the business kind of, yeah, we almost have to kind of reset them a little bit, right? And change their expectations and, kind of try to train out the bad habits and try to reinforce the good ones. But if you could do that, it becomes a very, very powerful machine for you. So,
yeah. Management is definitely difficult. I mean, we hire third party property management, but we've went through several different companies, and I feel like some of the successes of the good companies is that they're hiring the right people and they're firing people quickly if needed to rehire the right people, and they're also providing training. Those are the two big things that I see. um, the differences between the good and the bad companies is just that.
yeah, no, there's a phrase, hire fast, fire faster,
Yeah,
right? And
yeah,
training is the other thing too, where, we're at the point now where we want to hire on a full-time trainer, right? Because, it's hard to, you get so big and it grows so fast that you have to get that consistency, right?
yeah.
Otherwise, you don't know who's doing what, and so training is kind of a crucial part of success of management. And so that's where today we have the regionals that do the training, but unfortunately they don't do a consistent job, right? This regional trains different lists, so now we're, hey, how do we kind of consolidate that and centralize
Mm,
training to get the same economies of scale for everybody?
yeah, very true. um, what are three kind of success tips, things maybe that you do on a daily basis, on a weekly basis, things that have really helped you become successful?
Good question. But, I think the first one is getting educated, right? I mean, that's why, I learned a lot of what I know from listening to podcasts like this, right? Getting out there, be willing to get educated, not go, go in eyes wide open, right? Assume you don't know everything. I think that's a huge one. And, even till this day, as much as we've done, I'm still constantly learning,
Yeah,
constantly
and
asking
that's something.
questions. Yeah, and I mean, it's just, it doesn't matter how much you've done, right? That's where,
Yeah,
I enjoy being parts of certain masterminds. I mean, if I go to a mastermind, I'm the biggest fish, that's a problem. I really want to go to ones where there's bigger fish there and I can learn
yeah,
from them. And so I think that's a huge one. Always be a student, right?
yeah.
Next
It's
one is
funny.
real.
It's funny when you're, you're sitting there buying your fourplexes, single families, or whatever, and if you would have looked at somebody that's got 650 million assets under management, you would have been like, "Whoa, I'm sure they know everything." And now you're there, and you're like, "I know nothing." Yeah,
Yeah, so
it's
I
like,
just know enough to be dangerous,
yeah,
right? And
right, right.
that's where my job today is really to make people the best them, right?
Yeah,
It's about hiring people better than me in every situation and help them be the best version of themselves, right? And what's jamming them up? What
love
do they
that.
need help with? Where do they need assistance? Where do we need to solve a problem? So
Yeah, love
that's
that.
kind of the trick right there. So um, yeah, and so then kind of continue on. So I think education is huge. Next one is really network, right?
Mm,
Always be networking. Like I get mad at myself whenever I find myself stuck in the office for 2 weeks, right?
yeah,
Versus like, man, I need to be out there meeting people, cutting deals, making partnerships and figuring out what's next. And so I think that's something not a lot of people do well. And one of my big regrets is whenever I was at Microsoft, just not building my own brand. I mean, I met so many people that liked me, that trusted me, that didn't know anything about real estate that I could have easily turned into investors, but I wasn't doing real estate at the time, nor do I have a way to communicate that to those people, right? And so I think that was
Yeah.
a big miss. And I think building your brand is something everybody should be doing because it's a thing that is yours, right? You go elsewhere, you change positions, you go to a different company, whatever, right? Well, that's something they can take with you, right? So
Yeah.
I think,
Yeah. That's so
yeah,
valuable. I like how you said that even in like Microsoft, when you're there, you could have been building your brand. You could, and at the same time, you don't even know, maybe you didn't know about real estate. Maybe that wasn't even part of the cards. But if you're like listening to this, well, if you're listening to this, you're probably thinking outside the box, right?
yeah,
But for people just to build their brand, and I'll constantly be networking and build that, it just sets you up for success in whatever way comes, right? It doesn't matter that you probably at many times didn't think you were going to be a real estate. You probably would have never thought you were going to be in the position you're in. I know I didn't, uh,
same.
you know, but by just growing that network, and thinking about building your brand, I mean, you're just setting yourself up so much more success, no matter what you end up doing.
Absolutely. Absolutely. And then that's probably a good segue to the third one that I would say, which is you got to always be interviewing and building your bench, right? If you're growing fast, I mean, I'm learning that every day. Like, I mean, we've hired 30 people in the past 60 days. We're probably going to hire another 30 people in the next 60, right? But it's hard to get good people. You have to
Yeah, always be hiring.
always be hiring, always
Yeah,
be meeting people. I mean, heck, I interviewed someone yesterday for a position and I went over to my partner, Ben. I'm like, dude, we need to hire this guy, not in this position, but somewhere in the company, like this guy, we need to bring him on, right? Find good people. And, there's a book, right? What is it? Who, not what, right? And, I haven't read the book admittedly, but I think it's really more about defining what you need and then find the right person.
yeah,
Whereas I'm starting to see the value in the inverse, right? And find awesome people, then figure, okay, where can I put these people and, to grow and, can I set up something that they're content with, that they can grow with, and vice versa. So,
yeah.
it's always about just having a good bench of people, and that starts to allow things to snowball.
Who, not how. It's a great book.
Yeah, I haven't
Um,
read it yet, so I was
yeah.
gifted it. It's literally sitting on my bookshelf at home.
It's a fun book. I mean, you've got the concept down already, so it's
Yeah,
fairly simple, but it'll bring some stuff to your brain. Be like, oh yeah, let's do that.
yeah.
What's a mistake that you've made? You guys have done a lot of deals. Certainly, you've made at least one.
Oh, we made tons of mistakes. I mean, we still make mistakes today. Um, I think the biggest mistake we made is probably not understanding the value of reserves up front. Right, I'm a big believer. If
Huge.
we screw up a deal, that's me and my partner's fault, not my
Yeah.
investors, us. And we're gonna be the first to try to fix it. And it's funny, we had a deal where it was before we created our management company, where we thought we had a pretty good amount of reserves to the point where we're like, what, maybe we just distribute some of this back, sooner than later. And fast forward, the management company completely screws it up, builds up a ton of AP. And then we have the inverse problem where I'm like, well, shoot, we don't have enough reserves. And so now we've learned it's not about squeezing juice from a turnip, right? Our deals are not about, hey, here's the most efficient way to maximize the dollar on this deal. It's really about understanding risk adjusted returns. And that's what we
Yep.
try to educate our investors on. We structure risk adjusted return deals, period, right? We
Yep.
do a lot of things to mitigate risk, a lot of reserves on some of these deals. I mean, we have a deal we bought for $11 million that has 1.2 million just sitting in the bank for the past year and a half for just fun. And, I've contemplated, should we do a big distribution? Well, now that rates have gone up, now I'm like, man, we're sitting great. I'm glad we still have that. So I think the biggest mistake we made, and a lot of people make early on, is thinking $300,000 is a lot of reserves. Whereas nowadays we're talking two, three, $4 million of reserves in some of these deals.
Yeah, I couldn't agree more. And I did the same thing, or very similar. My first deal, I had these reserves. I thought they were really big. Looking back, I'm like, holy crap, that was tinier amount of reserves. But I thought, like, I don't want all this cash sitting around. I don't want to put my investors' money to the sidelines and not do anything. So I don't need these huge reserves, and I won't need them anyways. And same thing. It was like you get to a point you're like, oh crap, I'm gonna need more reserves. Like, what's going on here? And so we're the same. Do you have like a benchmark that you put a certain amount, or is it
No,
deal
not like
specific?
one hard benchmark. I mean,
Yeah,
y- yeah, it's really more about the deal and the situation
yeah,
and how much capex we're doing, right? But if I was to say 10,000 a unit, right? So for a 100 unit deal, it's $1 million of reserves. Maybe it's a little bit high, but somewhere in that 5 to 8,000 a unit, just extra reserves is probably a good space to be. And again, maybe we're
yeah.
too conservative, but again, it doesn't really hurt the deal metrics too much. I mean, yes, it waters down returns, but again, we're talking about risk adjusted here.
But that is a way that I think people, um, some syndicators will make the deal look better is by having smaller reserves. And so
Oh
if
yeah,
you
for
have to
sure.
raise less money, and it's another thing, like if somebody's a little short on their raise, they'll maybe compromise on that reserve. And that's a dangerous
It's
position to be
exactly.
in.
But the same thing, leverage. I mean, it's funny. I used to think you got to max leverage because mathematically that is the most efficient ways.
Mathematically.
Whereas now we got a deal we're buying in 2 days that's 55% leveraged. I mean,
Yeah. I
and we feel
love
great
that.
about it. Like, I mean,
Yeah.
yeah, it feels great knowing we can pay the note and have a lot of money, kind of positive cash flow sitting after that. So again,
It,
if I mathematically I could squeeze a 16 IRR and instead I take out the risk and make it a 14 IRR, 13 and a half IRR, guess what? I'm taking that bet all day.
Yeah, I agree. It's funny because we've had internally a lot of those same conversations about LTV and very similar. Like not very long ago, we would have said, well, let's do 75%
Yeah.
LTV because like we want to we want to maximize returns. And now it's like, well, wait a second, let's look at the whole deal. 60%. That sounds a lot better in a lot of cases, and you know instead of a shorter term debt, let's go longer term. Like you look at the risk adjusted returns, it just makes so much more sense taking a lot of that, burden off of you and off of your investors. I want to sleep at night. I think
Yeah.
most of us want to sleep at night. So if we can do some of those things, it just makes so much more sense.
100% agree. I mean, it's just, yeah, we like going down leverage on the leverage stack. Now I get it, right?
Yeah,
Whereas new
100%.
people to it, but you didn't get it, right? And you thought it was crazy for these groups that go 60% leverage, and now we are those groups. And so it's kind of funny to see how things go full cycle or full circle, right? And you start to realize
Yeah.
there's a lot of reason why people do certain things.
Well, and I understand it on the leading edge too, because a lot of these groups, first of all, we've talked about a lot of different things, but going to the C class building, it's a lot cheaper to get into typically a C class building. So that's why a lot of beginning investors are going to that C or D class even building, and then going 80%, 75% LTV. Well, when you're first beginning, you just can't raise as much money. That's just how it is. And so a lot of times you're maybe putting a lot more risk on your investors than what you really realize. So it, I get the reason behind it, but if you can at all avoid it, for those who've, we've learned from some of our mistakes. Now we're willing to do that 60%, maybe 65% LTV. We're looking at better product, better areas. There's a reason for that. And like you said, it's just, you look at some of those companies, you go, why are they doing it? And then you start to do the business, you go, that's why they're doing it.
Yeah. And it's not to say there's not a spot for high leverage deals too, but you got
Certainly.
to really know what you're doing. And if you're working with other people's money, 9 times out of 10, it's better to just take the risk out, play it safe than to, go all in.
Yeah.
Versus if I'm doing it with my own money, a deal that I know very well in an area I know very well, where it's like, hey, I can make some real money here. Sure.
Yep.
But, with
Take
kind
that
of
risk
deals we're
out.
doing today, it doesn't make sense. So
Yeah. Agreed. So you guys are buying a deal shortly here. Obviously, you're still active in the market. A lot of companies are pencils down, or at least like, maybe if we find a smoking deal, we'll go, but we're not in. What makes you confident purchasing a deal right now in this market? And I guess what makes you confident and why?
I think that Warren Buffett has a phrase for this, right? Where, when others are fearful, that's the best time to kind of go in. I think ultimately the fundamentals of multifamily haven't changed. right? The cost of capital's gone up, but the real estate is still very attractive, and specifically multifamily. And
Yeah.
so we still have rent growth. Yes, rent growth has slowed down a little bit, but again, it's about getting into good assets, good locations, and really, if you're in it for the long haul, right? We're not buying our deals for the next 2 years. And as a matter of fact, we're actually shifting our model a little bit into kind of basically what we're calling legacy deals, right? We're buying deals. Hey, how do we get into this deal for the next 15 years,
Yeah.
right? What does that look like? How do we structure it to where it's a win-win? And so for us, the fundamentals of multifamily haven't changed. And so, continue to buy, and the lack of demand has actually made it to where we can find some really attractive deals right now.
Yeah. If you're looking at these legacy deals, you certainly have to talk to your investors differently because you're not IRR driven. Certainly, you're as much. How are you having these conversations? Because I can't imagine a 15-year deal. You could say, "Hey, we're going to hit a 15 IRR in
It's with the
15
refi,
years."
right? That's really explaining the value of the refi and the value of, hey, if our goal is to get into this deal in 5 years, you have all your money back, and we're just holding on to this deal with
Yeah,
infinite returns, right?
yeah,
That's really the pitch, and explaining why the deal, why the location, the quality of the asset, right? Why it's different than the typical B, C value add that we've done.
yeah. So again, it's not selling the IRR. It's selling the cash flow. It's saying,
It's selling
"Hey,
the story, right? Yeah.
right, this is a great location, great product. We're going to cash flow, and then we're going to refinance, and we're going to give you all 50%, whatever it is, of your money back, and then we'll just hold this."
Yep.
That's good. I love that. I love that strategy too. I think obviously I understand the flipping of the multifamily, and we do that as well. Maybe not as much as some people are doing it every 2 years or year even. They're just like getting in and out of this property so quickly, and I get it. It gets them experience. It gets investors big returns. It looks sexy. But man, there's something to be said about legacy properties like what you guys are looking at. And I
Hmm.
think there's so much value in that, especially if you look at the longevity of your company, disrupt equity. If you guys are doing that and you have some legacy product, you're probably going to be a company that's going to have some staying power in the market for the long term. I think a lot of
Yeah.
these flippers that are just habitual flippers and don't keep anything may not be a long-term company.
I completely agree. No, I want to be that crusty old guy that the brokers chase for 20 years, asking to sell the deal, and finally let them sell a deal, right? That's kind
Yeah.
of the goal. So,
I love that. I love that. I've said I want to be like the 95-year-old that goes in
yeah.
and purchases a deal, and people are like, "What are you doing with this?" "Well, I'm going to hold it
Uh-huh.
for the next 30 years."
I agree 100%. So,
Yeah, love it. Are you guys seeing anything in the market, in the economy right now that's making you say maybe we should pause, or are you?
um, rates are sky high, right?
Yeah,
Rates will probably continue to drip up slowly. I don't think they're going to go down quickly, right? And so there's concern there, but that's just really just changing how we look at our reserves, right? And we literally model these deals now where we're buying the big interest cap, modeling all the cash that we need, and making sure that if we go to refi, that based on where rates are today, that DSCR still makes sense, and we have enough money to do that refi. And I think a lot of guys are ignoring that piece.
yeah,
People go in saying, "Hey, I have a 311," and they don't realize that they're probably not going to qualify for that first extension, let alone they're not going to get the leverage that they think they will on the refi as well,
yeah,
right? But they're going to get a much lower amount. So and may probably need to bring cash to closing, honestly. Whereas, we've been very particular on spending the energy to model these. And so it just kind of shifts the deal structure a little bit. But again, the fundamentals are still there. And, if you're buying for the next 10, 15 years, I don't really care too much about what
well,
happens in the next two.
and one of the positives about buying in a higher interest rate environment is if you're buying it right now and it works,
And the rates
then
go down, and then I'm, sitting beautifully. So,
right, exactly. And the chances of between now and the next 5 years of interest rates going down, I think, are probably pretty good.
yeah.
You never know, right? But I think they're probably pretty good. So that's definitely a good point. Um, yeah, it just it's going to be an interesting time. Do you have any predictions of what we're going to see?
I think rates will flatten this following year. I'm going to go up a little bit and just kind of plateau.
Mm.
I don't think there's going to be a drop for this year. I think it's going to roll into 2024 before we start to probably see a little bit of a drop. So
You think we're going to see some good deals coming anytime soon?
I think summertime.
Yeah,
I mean, I already see these
I'm
deals
kind of
like where
with you.
guys, have some reserves and they're feeding their deals 70, 80K a month. And fortunately that can only last for a couple of months. So
Yeah. Yeah. They burn through reserves and then what? Like you got to
yeah,
get rid of a receiver comes in and says, hey,
I completely
you
agree.
know,
So I
we
think
got,
summertime will be an interesting time.
yeah, agreed. How are you guys? Are you doing anything in particular to position yourselves for that?
Um, just doing our thing, right? Continue to just work hard, hire the right people, get our investors just comfortable with different deal structures,
Yeah.
and continue just to be the guy that the brokers want to call the first guy, right? So that's kind of us. I mean, I was talking to the broker the other day, and he says, the thing we have going for us is we've transacted a lot in this environment, right? And so brokers know that we can perform. And so I think again, once those deals start to show, we'll probably be one of the first to get those calls. And we move quick, we make it easy. So
Are you at all worried about inventory? I think you mentioned Atlanta you guys are in,
mhm.
and I just saw something today and I haven't fact checked it. So who knows how accurate it is, but Atlanta had, I think, an increase of like 67% as far as new construction in multifamily. Are you, concerned with any of these markets that are having a high amount of building, or do you feel like the population of Atlanta is
I mean,
going to
we
absorb
invest
that?
in high population growth markets. Atlanta is a
Yeah.
huge population growth. But yeah, I
Right.
mean, new inventory is always a concern. And, the deals that we buy, we do look at how much inventory is coming online. The perfect example is a deal that we chased where, I won't mention the name, but the current owner essentially bought the deal and there was something like 600 units coming online in the mar, and then ended up being 6,000 units. And that's what ultimately caused them to really struggle with that asset. Right. And so being conscious of
Mm.
that and again, most of our deals are not in the bougie high growth submarkets,
Yeah.
right? We're more outside of that. And so you kind of have a little bit of what's the word? A little bit of resilience, right? Knowing that. But again, it can happen and something you have to be aware of, right? So
Yep.
last thing you want to do is to go compete against the lease up, right?
Right.
Those guys will give away the farm.
Right.
We're stabilized. We can't give away the farm. So
Yep. Yep. 100%. Cool. Okay. Couple last questions, and then we need to wrap up. So, what's a favorite book that you can recommend to our listeners?
Favorite book that opened up my eyes was The Millionaire Real Estate Investor,
Hmm.
right? That book, it
Is that
just
Gary
kind of,
Keller?
yeah, the
Okay.
guy that started Keller Williams. And
Yep.
so if the audience had not read that, I highly recommend it. And it just gives you the overview and kind of the pillars of real estate and why it's an attractive long-term asset class,
Hmm.
right? And my favorite part was just where he kind of does the example of the couple that makes something like $50,000 a year, right? And how does that couple retire millionaires? And so I think it's a huge eye opener. Great book.
Love it. Um, how do you like to give back?
So we have a charity called Disrupt Gives actually that we launched, and
Oh, that's cool.
we put 25% of our fees into that. And this year we did over $100,000, and next year will be significantly more than that, and starting to really scale it out next year. And it's focused on basically tenant financial literacy and rent forgiveness. And so really trying to educate people, because the problem we see is there's a lot of rent charities out there. But the problem is, money's given to people and they go back into the same
Yeah.
problem, 2, 3, 4, 6 months later. Whereas ours, if we want to forgive it, but we want to essentially educate people and make it a requirement for them to go and complete a certain amount of financial literacy just so they can go back into the labor market well educated and just, wiser with their money. So it's something we're excited about and something we created actually, it's a formal IRS compliant charity, 506(c). But I think next year will be kind of the real growth year for that charity. So something super excited about.
That's really cool. I applaud you for that, and that's very near dear to my heart, man. I mean, the very first rental property I bought was a single family home, and this young lady moved in with her kids, and she was on Section 8, and she says, "When I get off of Section 8, are you still willing to rent to me?" And I said, "Absolutely, of course." And she said, "Okay, good," because my grandma was on Section 8, my mom was on Section 8 and now I'm on Section 8. And she said, and I'm not going to be on Section 8. I'm going to break the cycle. And she was there. I don't know where she is today, but during my time that she was a resident of mine, she was never able to break out of the cycle. She ended up, I ended up having to evict her because she couldn't pay her small portion of rent. And so I ended up having to evict her. It's just sad to see like this cycle repeating. And like you said, there's financial help. People can go get county assistance or Section 8 or whatever it is, but they're not learning anything and they're not getting out of the habit. And they're just taking that, their bad habits, and they're passing it on to their kids and their grandkids and so on. And so, yeah, I love what you guys are doing. I think that's amazing. And man, I would love to see that just be something that continues to grow and really truly affect people.
No, absolutely. So we're excited about it, and plan to put a ton of energy into it this next year or two. So
that's really cool.
We'll kind of see where it goes.
Yeah. Last question: what are your 3 pillars of wealth creation?
Oh man, I thought we went through those earlier. So
no,
I'll say
those can be
it's the same 3, man. It's about. I mean, actually, I'll change one up. It's surround yourself by people that are doing what you want to do. I think that's a huge one. I totally believe you are the average of the 5 people you spend the most time around, and I think that's a huge, fact. Period. Right. And so surround yourself by people that are doing what you want to do. Second up is always be a student. Again, I think that's crucial. I think there's so much that you don't know, even though you think you know. Yeah. Right. And then, last but not least is just the network, period. So I'll combine those two. It's really the network, both people that you're hiring as well as people you're meeting that, that could be investors. And, always be out there, right? Because a person could be a partner, could be an investor, could be an employee, could be a seller, could be a buyer, right? Any of these things could be that person. And you just never know who's going to walk through the door. And, the perfect example is my wife just saying, man, do you not get tired of networking or go to these events? And I'm like, well, I just don't know who I'm going to meet. Right. You never know. And so I met my partner, Ben, to, at a meetup. And so this stuff works. And, that was many years ago, and we've built what we've built. And so always get out there and, I constantly be the person that'll take action. I'll add that in there too. Yeah. Don't be the guy that goes to the meetup for 5 years, just literally to hang out and never takes a step forward. Right. Don't get into analysis paralysis. You have to always be a little uncomfortable. Every deal I've bought, I've always been a little uncomfortable, right? Like it's never like, hey, this deal's a home run, from the get-go, right? You don't really know what you buy until you're 90 days into it. Then you have an idea of, okay, what this thing truly looks like.
There's always going to be surprises. There's always going to be issues that come up. It doesn't matter what you do. You can't
A, B, C, it doesn't matter.
You can't be prepared enough for everything. But that's why we do things certain ways, right? That's why you have reserves. That's why you analyze it and think about the risks that are involved. But you got to take action. Like you said, you have to take action. It's so important. So many people think they got to go big or whatever, and they don't take the action because they are too scared to, because whatever, there's multiple reasons, but you just got to get out there and take the action. That's why I never discourage somebody from buying a duplex. Like, go ahead.
Go get uncomfortable, right?
Right.
If you're uncomfortable, you're probably growing. So that's the big thing.
Yeah. Love it. Well, look, man, I really appreciate the time and just a ton of insight. Love hearing the story and all the success tips along the way. How can our listeners get in touch with you?
They go to disruptequity.com or send me an email, Feras@disruptequity.com, Feras.
Feras, really appreciate it. Again, you have a fantastic rest of the day.
You too. Thanks for having me, Todd. Really enjoyed it as well. Take care.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to VentureD.com VentureDproperties.com, VentureDproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.